All right. Hey, good afternoon, everyone. It's Tim here. It's 3:45. We've been working all day, trying to put reason behind the market movement that we've been seeing, and there really isn't a good way to do that. And so, what we want to do is just talk through a few things. Okay. So this is our corn chart, and then this is the corn spread. Okay. So I want to show you the spreads first, because typically, if you're going to have a weather rally like we've had here, typically that is associated with a decrease of supply, which would be associated with a rationing event, right? This is why we rally it. Supply is coming down. We've got to make it more expensive to make it more, because it's becoming more scarce, right? So when you rally a market like that, you would expect that the front month would rally with it. But here's what the July to December spread has done. Okay, so this is just July corn minus December corn, and we've been inverted on this spread pretty much, I think, since its whole contracts. But so this is at the top end of this range here. This is 82, and what that means is that the July corn contract is trading 82 cents above the December contract. Okay, so that's an inversion, which means that there is no carry in the market. So trading the inverse is very, very difficult. And typically, what you should do in a normal environment is that if you believe that oversupply is coming, what you want to do is you want to sell the spread. You want to sell July and you want to buy December, because July, the front month, should collapse further than the back month. So if you see this action right here happen in a where you go from an 82-cent inverse all the way down to a 36-cent inverse in a matter of 1, 2, 3, 4, 5, 6, 7, 8 days, if you collapse that spread that far that fast, you would expect the headlines to read huge rains across Illinois and Iowa, and you would expect the July corn chart to look like death. You would expect it to be going just down, 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 and you would expect the December chart to look more a little bit more stable or a slower slant than July. Okay, and then the opposite is also true. Is that if weather comes in and there is rain all over the place, you should see this, not this. So what's been happening here in this spread is really mystifying over the last 8 days, right? Because over the last 8 days, what we did is we rallied December corn like crazy, right? This is the time that the spread collapsed, and we actually rallied the December corn contract. And we actually rallied the July corn contract. Sorry, that's beans. We actually rallied July corn harder than we rallied December. So that spread behaved opposite with what a weather scare should have behaved. And now on the decline, this spread has behaved opposite of what you would have expected. This spread has actually strengthened on the decline, and it collapsed on the rally. So this makes no sense. I reached out to some friends of mine that are merchandisers, guys that I have a lot of respect for, and their response was, "We have no idea why this spread is behaving the way it's behaving. It's completely counterintuitive to us, and we don't understand it." So um, I think that just tells you that what we're seeing on the December corn chart is a lot of confusion and a lot of uncertainty. Okay, and so um, uh, when you look at a event like this where you're straight up and straight back down, you want to put a reason behind it. And you can say, well, it's because the rain got more certain. No, it didn't. It was in there the whole time. They never took the rain out. They actually just delayed it. And so if you're trading on projected future rain, then you wouldn't have done this. You would have just stalled it out a little bit and then collapsed it when the rains hit. So I don't know really what's happening here in the corn market. So let's take a look at what our balance sheet is. Okay, so let's run through some numbers there and try to get a bias. This is what the USDA has told us that we have to work with. Okay, so this is the only known information that we have. The problem that we have here is that this number is the yield of 181 is now in question because our good to excellent ratings are only 50%. And they're the lowest that they've been since 1988. There's very few years that are similar, and so the ratings are not indicative of a yield this high. So maybe the yield is 170, maybe the yield is 175. We don't know the number here, and so you could get some volatility as the trade tries to predict that. You can also look to spreads to try to figure out what the market thinks this beginning stocks number would be, because that would be reflective of what the market thinks there. So if we look at the spread chart again, what you might see if you're just looking at this number as a static number, which is an inverse of 65 cents July to Dece in the week of first notice day, what you would expect to see there are very light stocks, or you would expect to see that the USDA maybe is going to shrink this number somewhat. Okay, so let's pretend that the USDA shrinks this number by, I don't know, let's pick a number. Your guess, let's take it down to a nice round number of 1,250,000,000 bushels. Okay, so we lose about 200 million in beginning stocks, and we lose a little bit of yield. Now you're starting to see why we might be bullish, right? Because now you have a 1.5 billion bushel carryout, which is starting to come in line with what our yield was last year. So I think the market is trying to price in somewhere in this vicinity. Now what it has to do next is get to the, so we get this number Friday. This number may move a little bit on Friday, but we're not expecting it to move much as far as acreage. This is the number that's in question. Then we look to July 12th, which is the next WASDE report, where they're going to manipulate yield and demand. And what we may see them do is we may see them shrink both, right? We could see them shrink yield and demand down and hold the carryouts high. But what we don't know is where the yield may go, because our conditions are worse than they have been, and the vegetative health indexes, all of those indexes that we have are just not good. So it's got to start raining, and it's got to get here fast in order to stop the decline. Otherwise, we do have a major problem. So I think what the corn market is doing is it's saying, hey, we don't really know what to do. It's completely undecided, so it put itself right back in mid-range. Now, you can also say, hey, you have a cloud that is belly down right here, which would act like gravity or like a magnet and pull price back to it before it consolidates and goes higher. That's very, very possible in this situation, because some of the shorter term wave counts that we've been looking at are showing that this wave may be done, and we probably need to bounce back up. And I still think that we could get a bounce back up into this higher level. But before we thought, hey, a move back to 610 would be a B wave, we should sell it. I really don't think that's the case. I think we've come too far, and we're not going to get a B, C. I think what we need to do is see how this move unfolds if we're lucky enough to get it. But if you're nervous and you want to get protection on or increase it or put it back on or whatever, then I think puts are the way to go. I think minimize the amount of money you're going to spend, put some short-dated puts on, maybe even sell some longer calls up above, but put some short-dated stuff on here just to get the protection. So if we do go to new lows, that would be easy to, I don't know how to get this off there. There we go. That would be easy to manage. It's something that is pretty clean, pretty simple to handle, okay? So I think if you're going to do anything, it is either short futures, long calls. I think it is long short-dated puts. You may even back spread it, sell several 580s and buy multiple 540s or 520s, and really try to catch a move lower if that were to materialize. That's a strategy you can have. The safest and probably most docile would be short futures, long calls. To protect you against any kind of situation, because the recipe is in place for volatility to be here both directions. If the trade thinks we're headed to that 170 number and our carryout is lower than it was before from a beginning stock standpoint, then we're going higher, because we can't handle a balance sheet tighter than $1.2 billion or less. So if that yield, if that is really in jeopardy, then that's where we're headed. And again, we've said this before, if that's the case, we're not worried about $6 corn. It's $7.58. We're probably into all-time highs. Now, on the flip side, If they crush demand and we have a decent crop, then lower we go. But I think that the grand conclusion is that over the last several weeks, we've trimmed this yield number enough. Remember, this is what we were worried about, okay? We were worried about a 181.5, about a 1452 beginning stock number, and call it a 13.7 demand number. We were worried about that. That's a 3 billion bushel carryout. That's $3 corn. That's where we were set up with our current demand numbers. The yield here coming down has done enough damage to really help this out. And if the USDA doesn't want to trim that demand number too far, we could get too tight. So I think the grand conclusion with our balance sheet and the way you manipulate the numbers is that the USDA can control prices. And they can keep it from getting too high, and they can keep it from getting too low, unless the crop conditions get so bad they can't ignore it. So if it does rain, I think we're range bound. If it doesn't rain, then I think we go higher. I think the downside is muted or limited, and we're probably, maybe down to 450, 475, somewhere in that area, because our balance sheet just doesn't get tight enough. So we're really kind of at the 3/4 mark of what the new range could be if our balance sheet is going to be somewhere between $1.4 billion and call it 1.9 or 2 billion. I think that what we've done is the weather has taken the bottom end of that out, but probably the USDA has got enough ways to manipulate it to keep us from putting the top end out. Okay, so that's our grand conclusion. I think that's the only way to explain all this stuff with the spreads that we're seeing. I think the trade thinks that maybe we're tighter than we are, but it's recognizing that the USDA can control it and keep it down in this range and not have to worry about it. So time will tell. I don't think we'll know anything until we get into the week of the 5th, 5th, 6th, 7th, and then the report is the week after that. So I don't think we'll know anything until we get through those 2 weeks, and we'll just bounce between now and then. I don't think that we're going to scream a lot lower, but this is the shelf you got to watch. 550, 560. It gets any weaker than that, then we want to be hedged. Okay, soybeans. Not quite the same situation here as corn from the bearish perspective, because if we look at the balance sheet on beans, we're tighter. So if we have a 52 yield and we have the demand that they say that we have, then our balance sheet doesn't get a whole lot worse than what it is. So we're probably aren't going to scream a lot lower. But yet, if we drop our yield, we get really tight really fast. So you take 2 bushel an acre off, you're at 200 million. Now you're probably sustaining something in the $13.50, $14 range. So your downside's pretty limited on beans here too, unless they raise the acreage significantly. So I think what the weather rally's done is limit our downside. And I think the USDA's got enough room to manipulate the numbers to keep us range bound unless the conditions get worse and we really do see significant yield loss, and then they can't do anything about it. We got to go higher. So we don't want to ignore big bullish price action because that's where it could go, but I don't want to get too nervous about the downside either because I think it's relatively limited until we see some type of evidence of much, much bigger yield. I know that's a kind of convoluted way of thinking about it, but I think that's what this convoluted is the only way to explain this type of Christmas tree type price action that we've got going on. Okay, so now let's look at corn or at wheat. Here's September wheat. Wheat is just all over the place, still just stuck range bound, right? So even though we may bounce 70 cents every day in wheat or 40, we're really just not going anywhere at all. All this resistance up here is holding and all of this support down here is holding. It will change eventually. And so you got to just sell the top and keep your upside open because you know where you're wrong up here, right? It flirts with it and it tries to convince you that you're wrong, but you do know where you're wrong. And down here as well, you're wrong to be short as we get down here until it comes back out the bottom of it. So, not a whole lot to talk about with wheat because it's just trapped in this gigantic training range and it's really, really tough to trade and it's really annoying. So I don't have any bias whatsoever in wheat at the moment. Okay, that's 15 minutes. Again, I think that this is all positioning. I think everything about this market is going to make sense in the rearview mirror, and I think what we're going to end up doing is probably trading ourselves into a range unless we have additional weather scare and we gotta go higher because of yield loss. Otherwise, I think we're just going to sit here and we're going to chop around in a pretty wide range, kind of like this right here. So buckle up, don't get too frustrated. It's going to provide a lot of opportunities, but we're going to have to shorten our time frames. We're going to have to trade a little bit quicker in order to participate in it. So that's kind of our closing thoughts. Remember, this market just reminds you constantly that there is significant risk trading futures and options, and you should only do so in light of your own financial condition. I hope you guys have a great day. We'll be back with you tomorrow after we see the action and see how it closes, and we'll be staying in touch. Have a great night. See ya. Bye.